Facebook. I wanted to do a post as we are in the fourth quarter of 2021 on tax strategy. How we have 3 months and what can we do before year end to minimize our tax exposure. And I'm about ready to go into fourth quarter with our clients where we do tax strategy and make sure we're not missing anything before year end. And I thought I would share with you what some of those opportunities are so that you could have more in your pocket and pay less to the IRS. So let's talk about what some of those things are. When I think about tax planning, it's more of a marathon than a sprint. That's an old cliche. But it's really true. I mean, tax planning is generally something that we do throughout the year. However, before year end, we have a better understanding of what happened during the year. So we are more deliberate in what are the opportunities. So the very first thing to think about is maximizing your deductions in the years that you're itemizing. So with the Tax Cuts and Jobs Act that was recently passed, that legislation actually pushed a lot of people into the standard deduction instead of itemizing. And so you want to think about certain years when you're close to that threshold that it makes more sense to itemize. You want to lump or bunch some of those expenses to pop you over into the itemization category for your tax return. So one way to do that is charitable contributions. Instead of doing your annual contributions that you do to the charity each year, actually lump them into 1 year or every other year so that you can itemize, or prepay the state income taxes. So those are some of the things, or mortgage interest, to consider doing that ahead of time. So that is one thing, is to bunch or lump so that you cross over from standard deduction to itemization. And one way to do that is to create a donor advised fund. To do a donor advised fund, the amount you put into that fund, you get to deduct that contribution in that year and wait till later to dole out the amount that you want to give to specific charities. So a donor advised fund is a wonderful way to every other year or every third year do a large contribution into that account that allows you to itemize instead of taking the standard deduction. So that is a big one, and to really manage that. The second is obviously what you hear from financial practitioners all the time is to harvest tax losses. So when you have gains, you can offset those capital gains in your investments against capital losses. And then if you still have losses left over, you could actually take up to $3,000 of net capital loss on your tax return against ordinary income. And then if you have more, carry that over into the next year and the year after that. So a lot of practitioners actually harvest losses so that when they have a big gain, they could actually offset that loss directly, equivalent to the amount of the gain. So tax loss harvesting is something that you should be doing every year and managing that so that your gains don't get too substantial over time. And of course, this one, we all think about that if you have an employer that has a qualified retirement plan, whether it be a 401k, 403b, or a thrift savings plan, is to take a look at your pay stub and see how much you've contributed year to date, because you can contribute up to $19,500 for the year, and if you're over age 50, you could contribute another $6,500 for a total of $26,000 a year. So if you have the capacity to pay more into before you hit year end, absolutely take advantage of maximizing your contributions into your qualified retirement plan. And then the next one is to really watch the capital gains distributions. If you have an actively managed mutual fund, those mutual funds have to distribute the realized gains each year to the shareholders. And that is you, the owner of that actively managed mutual fund. We actually try to eliminate actively managed mutual funds in our portfolios and use more exchange traded funds, ETFs, or more tax efficient vehicles so that the capital gains distribution are not unexpected or throw us off too much. So if you have actively managed mutual funds, really pay attention to the exposure that you have in taxes each year as it relates to those unexpected distributions. Because even if you reinvest those, you still have to pay taxes that year. And then we already talked about opening up, possibly considering a donor advised fund. But the other idea, if you are to transfer IRA money to a charity, and if you're over 70 and a half, you can contribute up to $100,000 to a charity a year. And if you're over 72 years or older, you are exposed to required minimum distributions, RMDs. Well, a lot of our clients direct some of those required minimum distributions to a qualified charity of their choosing. And that has to go directly from the IRA to the charity, and it's called a qualified distribution. And so a QCD, qualified charitable distribution. And not only does that say, do you give to your favorite charity, you also meet some of your required minimum distributions, and you help on your Social Security exposure on income or the surcharge on Medicare. So there's a lot of benefits with doing a qualified charitable distribution from your IRA when you're over 72 and you have to do required minimum distributions. That is a big, big opportunity that a lot of people miss. And then the other is consider a Roth conversion. If we think taxes are going up, which more than likely they may, the ability to work the gap in your tax brackets to convert from your traditional IRA to a Roth, the amount up into to the top of your tax bracket is actually a really wonderful strategy. Now, obviously, you have to pay ordinary income on those distributions, but the growth of that Roth IRA money is all tax-free later. So there are advantages to when that is more attractive than others. But if we think that there's an increase in your bracket, a Roth conversion may be a really good strategy over the next several years, working that bracket gap. You may not pay any taxes on that Roth conversion, depending on which bracket you are in, since there are no taxes on capital gains in a certain category or the ordinary income. So, and then lastly, seek advice. The tax planning can be absolutely complicated, and you want to make sure that you do the right thing. So with any tax strategy, consult a financial practitioner, professional, or tax expert with knowledge of your personal financial situation. So those are my quick tips on how to knock it out of the park going into the end of the year to make sure that you pay less in taxes and that you're absolutely doing all the things that are available to you before year end. So thank you for your time. If you think this video is helpful, please share it with others. And I want you to know how much I so appreciate you. Thank you.